What's up, Gold Miners? Welcome back to Season 2 of the Gold Mine. And to kick things off for Season 2, we picked an incredibly exciting guest to bring on and kick off this season, David Sillaman. David is one of the foremost Opportunity Zone Fund experts in the entire country. After creating the second ever Opportunity Zone Fund here in the United States, David later went on to found EZOZ. EZOZ is an Opportunity Zone Development Agency as well as an Opportunity Zone Directory where Opportunity Zone funds and investors can connect. Right at the beginning of the episode, we dispel the myth that opportunity zones are a thing of the past. And right after doing that, we dive deep into opportunity zones, starting with the current legislation in place to extend the time window, the time horizon that is currently slated for opportunity zone investments. Later on in the episode, David and I discuss how investors like you and me can take advantage of this program and invest into a variety of different asset classes, not just real estate, which I'm not sure if you're aware of this, but I certainly wasn't aware that you can also, or opportunity zone funds can also invest into businesses. And we go over that in detail in this episode. The next 60 minutes are an absolute masterclass on opportunity zones, and David proves that opportunity zones are not just a thing of the past and can very well be a part of your investment strategy for years to come. This is an incredible episode. Without even having to think about it, I can confidently say this is one of my top 5 favorite episodes that I've ever filmed, and I'm super excited for this to be the way that we kick things off for Season 2. So without further ado, everyone, let's welcome to the show, David Sillaman.
The Gould Mine Podcast.
David, welcome to the Gold Mine.
Glad to be here, man. Thanks for having me.
You know, honestly, this has been a long time coming for the people back at home. David and I have had some technical issues on a few, had a technical issue on a separate occasion. We tried filming this episode before, but we finally made it, man. We finally got you here.
We're here now, bro. We're here now.
And I'm excited to dig in because really, like, the title of this episode has the word opportunity zone in the title. And so someone's just tuning in right now. They see, okay, this number, 2024 opportunity zones, like, hasn't that ship sailed already? Like, why are we talking about opportunity zones in 2024?
Great question. And the reality of it is, no, the ship has not sailed. This program is a federal program that does not expire till 2047. And there is an extension act in Congress that's going to be, once that's signed through, is going to be extending the program out significantly. But right now, it's a very, very active program. It's a viable program. Individuals with capital gains can still take advantage of the program right now through at least through 2026.
Okay.
So very, very much a viable program.
So where does that misconception stem from then? Why? Because I myself, if I'm being honest with you, I didn't even realize that, because like I was told, oh yeah, you can't invest in opportunity zones anymore. Like, right. That's what I was told.
Yeah. And I think a lot of that comes from, Danny, just there's a misunderstanding around the year 2026. And sure. Right now, the way that the statute is written, 2026 is the deadline date. December 31st is the deadline date to roll money into an opportunity zone fund. And I think that's where a lot of people are looking at this program saying, oh, they think it may have already expired. It has not. And the negativism around it is simply because there is a expiration date coming up. But again, that's not until December 31st, 2026. And that's going to get extended out probably to at least 2030.
I see. Okay, gotcha. And when will we know whether or not that bill or whatever gets passed by?
Well, it's already passed
House
on the Senate side. So now we're just waiting on the House side. That's probably more than likely wrapped into whatever the tax bill is that the House is working on right now. So probably sometime in the next 4 or 6 months, I would imagine.
Okay, gotcha. So we're looking at maybe by the end of this year or like early 2025, likely some sort of extension. Okay, so let's talk about, because now, whether it's 2026 or 2030, what we're talking about is rolling money into an opportunity zone fund. So has that deadline already been pushed once before? Like, was the deadline previously not 2026? Was it actually like before 2026?
Great question. the deadline's always been December 31st, 2026. What there was, though, is there were some additional benefits early on when the program first launched for investors. So when they rolled money into an Opportunity Zone fund, they could get up to an extra 15% off their tax liability. So simple example, if I had $1 million gain from selling Bitcoin, I rolled it into an OZ fund. Instead of paying the tax, because the way the program works is I'm deferring the tax that's due, but then any growth on my investment is then tax-free. So that deferred tax that is due, I would have to pay the tax on $1 million sale of Bitcoin anyway, right? So I'm just deferring it from that date down the road. But early on, I got an extra up to 15% if I invested within certain time periods. So, and that 15%, what it related to was me holding for a certain period of time. So I had to meet a 5-year anniversary and a 7-year anniversary. If I met those two anniversaries, then by 2026, I would only pay tax on $850,000. So those two deadlines have already expired. The ability to invest today and hold for 5 years or 7 years and hit the 2026 deferment date, it's not possible on the calendar. Now,
I see.
What you think about that original benefit is even though that benefit has expired, that benefit is actually added back into the Extension Act that's sitting on the House side right now.
I see.
That added benefit, what it's going to do is, number one, that Extension Act is going to take that 2026 deadline date, and that's going to kick that down the road significantly. Like I said, probably to 2030, maybe 2031.
Okay.
In there, the anniversary period went from a 5 and a 7 year to a 5 and a 6 year, which means that I could put money in today, hold for 6 years, hit the deferment date, and realize up to 15% step up. So really what the bill is going to do is push that deferment date in a major way and then re-incentivize investors to continue to keep utilizing the program.
Understood. Okay, so now let's talk about that 15% because I'm still a little fuzzy on that little detail there. So when we're talking about the 15%, you said step up in basis. So in your example of the $1 million Bitcoin that you are buying or that you're selling, you still need to pay capital gains tax on that Bitcoin. You're just deferring the tax. But what you're saying is that there is a 15 when you invest into an Opportunity Zone from $1,001 to whatever you earn on that investment is tax free.
No cap. Yep. No ceiling. So you could literally put $1 million in. Let's say just a grandiose example. All right. Look at like OpenAI, you know, the company that put together ChatGPT. They're a relatively young company. You know, they're not what you would call like a really aged or seasoned business, right? They're only 5-6 years old for what they've done. If that would have been a business and you had that money go into stock and then look at what it took off to, you could have 100x return. You could turn your $1 million into $100 million. And that gap, that $99 million profit, tax-free.
Tax-free. Yeah. So when you say the step up, the 15% step up in basis, though, explain the benefit of that to the audience.
So, let's go back to that again, that Bitcoin example, right? When I sell that Bitcoin, let's just say on Coinbase, at the end of the year, I'm supposed to pay Uncle Sam some sort of capital gains tax on that. If that sale was for a profit, right? Whether it's long-term, short-term capital gains, doesn't matter. I got to pay Uncle Sam something. And I'm paying him that tax based on the million. Okay. The 15%, what it was an incentive, an early on incentive to get people to utilize the program when it was brand new. Right. Yeah. And it said that when that tax is due on that million, because instead of me paying that million, let's say I did it in, this year as an example, right? I'm kicking that can down the road. So I'm eventually going to pay tax on the million. It's just when, right? So that deferment date, December 31st, 2026. So due on the 2026 taxes sometime January through October of 2027, depending on whether I file an extension, et cetera. But that million, I would have gotten a 15% step up in basis. So the way to look at it is like a 15% reduction. So instead of saying, Uncle Sam looking at it and saying, oh, David, you sold Bitcoin for $1 million, you deferred the tax on it, you still owe tax on $1 million. The IRS is looking at it saying, okay, you sold Bitcoin for $1 million, but you took advantage of the program, you met the time parameters, you got the 15% step up, you only owe tax now on $850,000.
Right. Okay.
$1 million.
That makes sense. So like in that example, right, for just to bring it home for everyone, like let's say that you originally invested 500 grand and then you sold it for $1 million. Right. And so you're getting a step up in the basis 15%. I'm assuming the step up is on the original 500,000 in that example, right? So you're getting a 15%.
It's on the original capital gain.
Right. So you're going from 500 to like a 575 basis. Right. And so then you're only paying the, it is definitely an incentive, but I think the real juice is the non-taxable increase, or the non-taxable gain after the investment.
That's the big benefit for the whole program. And the nice thing, and the way that it works is, when I sell that Bitcoin, the situation for me being an investor who just realized the capital gain, and the thing about the program is, Danny, it's actually any kind of capital gain. Yeah, I mean, I could have sold real estate. Maybe I tried to do a 1031 exchange and I had a failed or a partial exchange. Well, this program's the second bite at the tax apple. So I can still take advantage of it. And when I take advantage of it in a 1031 situation where right now, 1031, I got to go from real estate to real estate, like kind of exchange, right? With this, I could go from real estate and then put my money into a business. So it doesn't have to be like kind. I just have to put the money in a 180-day window. So the way that it works is when an investor realizes a capital gain, does not matter the source, doesn't matter long-term, short-term. I have 180 days is the general rule of thumb. Now there is an exception to that rule. If I sold real estate and I'm realizing the gain on a K1 at the end of the year, I can elect my 180 days to start December 31st at the end of the year versus maybe I sold the property in, let's say, January of that year. So, but by and large, the rule's 180 days. As an investor, I've got a situation. I'm either going to use the program or pay tax. So I put the money, capital gain money, into an opportunity zone fund. Then from there, the fund reinvests the money into something eligible, geographically located in an opportunity zone, whether that's some sort of like ground up real estate project or something that needs to be rehabbed, or a business for that matter. That's a startup. Okay. For me as the investor, I have to hold my investment position in the opportunity zone fund for 10 years. 10-year anniversary is when I realize that step up when I exit. So if I put the $1 million in and in 10 years at 10x to 10 million, that would be tax free to me as long as I stayed in the fund for 10 years. Now, again, going back to the very, very beginning of why people get misconceptions with, expiration dates of the program. For me as an investor, the program does not expire till 2047. There are going to be a lot of right situations where I may be a very long-term investor in an opportunity zone fund for a 20, 25-year window of time, because that entire time, all my growth is tax-free to me. So it could be a very, very unique situation in that sense. So now you get into a retirement planning strategy utilizing the program, right? That's number one. Number two, what makes this program very unique is that this is the first time that something like this type of program's ever been done in the history of our country.
Right.
There are 21 federal agencies that support the program. There's all 50 states at the state level and at the local level have support initiatives in place for the program. It's a tax stackable program. It's a program that does not involve trickle down economics, but it's something that you just do and then report. So it's not a permission-based program. It's not an approval-based program. It's not a grant-based program. It's a program that, because of how it works in its fundamentals of separation of entities, meaning that you have one entity that's a fund, you have another entity that's actually receiving the money. You can tax stack benefits. You can use leverage. So just like how you would do like a real estate development project, for example, you might go, in the capital stack, you might look at some, maybe some TIF money, some loan money, maybe some grant money in there, maybe some tax rebates, whatever cost seg study might end up indicating, right? An opportunity zone fund can come into that for an equity play and be part of that capital stack. There's no minimum. There's no maximum. So when you look at a deal perspective, especially with the changing dynamics today with real estate, higher interest rates, banks lending less, we have a shifting real estate market right now. And so, a fund comes in for equity in the deal. It could come in and do 20%. It could come in and do 100% to where you completely, eliminate the need for a bank. But, it's a phenomenal program. It's just not a well-known program. There was a lot of in the very beginning, a lot of, cheerleading, rah-rah, siskumbah at the federal level. And then we had COVID, we had a change in election, and really the program just kind of been running silently in the background. And your big money takes advantage of it. Your large-scale developers take advantage of it. Prime example of a business taking advantage of it, Chick-fil-A just did a press release that they moved the first time a franchise into Puerto Rico, and they did it utilizing the Opportunity Zone program and made that franchise an Opportunity Zone business. So you're starting to see this is something that can be widely used for community revitalization.
Wow. Yeah, that's actually, I want to dig into that a little bit more, because obviously anyone who is investing into that sort of business, right? Think about all of the money that a business like that is going to make. Now, a question that just came up, right? So there's two things. There's appreciation and there's cash flow. So to me, it sounds like the appreciation is protected by this Opportunity Zone program. The appreciation is going to be tax-free. What about the distributions and the cash flow that are produced by the real estate, that's produced by the business? What happens there?
Great question. So again, when you follow the call it the structure tree, right? Typically for this program, the business is going to be structured really one of two ways, either like an LLC, LP type structure, or a C Corp issuing stock. So first of all, it's going to depend on the business that the fund invested into. All right. Okay. More than likely what you're going to have is a K1 situation. So the business will K1 to the fund based on whatever percentage of equity that the fund has in said business structure, right? So let's just say 25% as an example. So, on $1 million profit, the fund's going to see $250,000 come back to it. Then the fund from there can do one of two things, either depending on the fund structure, which again is either going to be an LLC or a C Corp. It either can do a K1 distribution to the individual investors based on the percentage of equity that they own of the fund. And that investor will simply claim that as ordinary income tax. Okay. That's option number one. Option number two is the fund can hold it, not do a disbursement, and reinvest it back into something else as long as it does it in a 12-month window of time and be shrouded from tax altogether.
Oh, wow. Yeah, this is a really interesting strategy. And that's through 2047. Are they thinking about pushing the 2047 date back too with this extension?
2057.
Oh, wow. So we're talking potentially over 30 years then of non-taxable gain.
Absolutely.
And you can roll the distributions back into it. Now, of course, people might. Okay, now question for you, right, David? So, and we're going to get into, what it is that you do with all of this. We kind of skipped full. I was so excited. All right, man,
we're diving right into
about the
potato. This is what everybody wants. Salad.
Yeah, no, this is so good, man. This is awesome. What a way to start season 2, by the way. And I lost my train of thought. That's how this goes. But okay, I was just there. Okay, so 2037 or 2057 rather. So we're talking almost 30 years of non-taxable gain. So for the funds, you just spewed off a bunch of different things here, and we kind of glossed over or skipped over the fact that I believe the majority of our listeners are under the impression that opportunity zones are only designated for real estate. And so now you just said something that we kind of glossed over it. You talked about businesses. So what can you invest into in these opportunity zones? And maybe let's give a broader definition of what an opportunity zone is, right? I know geographically, on a map, you can spot it, but what does this opportunity zone allow for in terms of, all asset classes that are, looped into this?
To answer the question, Danny, is to tell you what you can't do. It's a lot.
Okay, perfect. Awesome.
Answer. Okay. All right. So this program has an aspect of it called sin businesses. Okay. And they basically are the no-goes. And it's a very short list. The first three, just think of Trump. So no golf courses, no casino, no country clubs. Pretty simple. The next couple.
No golf courses, no casinos,
no country
clubs.
Yep.
Yeah. Okay.
All right. The next up, no ABC liquor stores where you would go in, buy a bottle of Jack Daniels off the shelf and go home. So no ABC liquor stores. No suntan parlors, tattoo parlors, massage parlors.
Okay.
That's it.
Really?
That's it. The easiest way to look at the program is it's Play-Doh. Okay. So let's talk real estate. Let's talk business. We'll do business first since you brought up a very, very valid point. There's a massive misconception with the program that it is only a real estate related program. That's not true. Okay. Remember how I told you that this was the first time that this program or something like this has ever been done in the history of our country? What makes the program unique is there's an equal emphasis on workforce development and new job creation as much as there is real estate development. So when the program first launched, because this is a tax program, obviously it takes tax legislation, guidance, OMB, bunch of, documentation that comes out that explains how to do this. As a matter of fact, the documentation that came out, it's a grand total of a little over 1,150 pages of tax guidance on how to utilize the program. It's broken into two tranches of guidance. Tranche number 1 came out first. That was real estate related, basically saying, here's the ins and outs of how to do this for real estate. Tranche number 2 focused on business. Took 18 months to get tranche number 2. We got tranche number 2 in December of 2019, at the end of December to be exact. Now, let's put a timeline into perspective. 2017, December, we had the Tax Cut and Jobs Act. June of 2018, the Opportunity Zone program goes live to the public. We get the very first set of 4.5 pages of IRC guidance. We get the initial statute. Then it was June of 2000 and, it was December of 2018. We get the guidance for real estate on how to do the real estate. It was then December of 2019, we get guidance on how to do business. We roll into 2020. Now, if you can think back, if you remember watching the State of the Union address back in 2020, one of the things that President Trump did was promote the Opportunity Zone program. And then from there, the White House Economic Development Revitalization Council under Trump had a program that was called Opportunity Now. And they went on a media blitz going all over the country promoting the Opportunity Zone program. You had Dr. Ben Carson, Scott Turner. You had Linda McMahon representing the SBA. You had a bunch of just people out there that were promoting the Opportunity Zone program. That was January to March. So a 90-day window of time. We finally have guidance. Everybody thinks 2020 is going to be the big year to launch the program. March of 2020, COVID hit. Then it went radio silence on the program. In the background of that radio silence, guidelines were given, COVID extensionary guidance was given out to the whole program. So what that did is it basically pushed the utilization of the program really from 2020 into mid to late 2021, 2022 being really the first real year of everything in place, no more COVID extensions, everything is done, all guidance in line. And we had a great year 2022. We had an even better year utilizing the program 2023. Last year, there was over $50 billion that flowed through the program. But the crazy thing is 50 billion is a lot. There's been roughly 300 billion over the last 6 years. That's a lot. But I'll tell you what it is. In my mind, $300 billion is like scratching Antarctica with a toothpick, thinking that you just found the mother lode of ice. Because the market cap for the opportunity zones, when you talk capital gains, last year, according to the IRS, it was $9.2 trillion in capital gains.
Oh, wow.
9.2 trillion.
Tax-free.
So that were last year, $9.2 trillion in capital gains was generated.
Through opportunity zones.
No, just period.
Oh, gotcha. Okay, understood. I was like, through opportunity zones?
Capital gain money that was generated last year. But what does this program focus on? Capital gain dollars, right?
Right.
So that's a lot of money that could move into the program to go into community revitalization through both real estate and business. Now, with business, the way that this program works for business is it's a different set of criteria than real estate. Okay. A business is actually going to be looked at through hours worked by your employees, right? Are they working in an opportunity zone? Are you creating jobs? What type of tangible assets does the business have? What type of intangible assets does the business have? How old is the business? Now, the one thing about this program that's unique for business is it's not designed for an aged company to utilize the program. Not without spinning off a sub-NewCo that maybe they have ownership in, and then that sub-NewCo can take advantage of it. But just a large-scale company that's been around 20, 30 years, it's not designed for them. It's designed to spur new business development in these opportunity zones. So, a little different criteria. From an investing standpoint, there's timelines that the fund has to do all this stuff in. Businesses get double the amount of time. So, you looked at as kind of like a stabilizer. So businesses get virtually 5 years of a window of time for a fund to make an investment in, let's say, over a 5-year window of time versus all at once. So it can be used as a stabilizer. For real estate, the way the program works for real estate is going to be broken into two categories, either original use or something that's called substantial improvement. All right. Original use is going to be ground up. It's going to be maybe a property that's been vacant, condemned 18 months or longer. So that would be classified as original use. Substantial improvement is, let's say, a property that you're going to rehab. So let's say like in a multifamily complex and you want to upgrade it, right? Still going to stay multifamily. So that's substantial improvement. With substantial improvement, there is a minimum dollar amount that has to go into improvements in the deal. So the way it works is, let's just say I'm going to use a real basic, just because the zeros don't matter, right? So let's say I found a piece of property for $100,000 that had a fourplex on it in Alabama that I wanted to rehab. Okay. And I had an appraisal done, and let's say the fourplex was worth $75,000. The land was worth $25,000, altogether $100,000. I have to put $75,000 in improvements. So I have to match the value of the building when I'm doing a substantial improvement under the opportunity.
So you basically have to pour almost double or the same amount of the
whatever the value of the building is.
The improvement value, not the land value.
What? Yep.
Okay.
Yep.
Got it.
Other than that, for real estate, like I said, minus golf courses, country clubs, and casinos, you can do it under the sun. And for business, as long as the business was established January 1st, 2018 or newer, it's not an ABC store, not a tattoo parlor, suntan parlor, massage parlor, you pretty much can utilize the program. And for business, and this is where I fell in love with the program, to be honest with you, Danny, it was not real estate. I was involved in a real estate deal. I came from private equity in the tech world, got involved in a real estate hotel turnaround project that happened to be opportunity zone. So that's how I got initiated in the program, because I've been involved with this since day one. But my passion for it is business, because what this does is this changes the nature of venture capital. As a business owner seeking to expand or grow my business, I can structure and set up a fund and offer investors into my business the tax-free benefits. I don't have to go to a venture capital now. I can just set it up, offer it out to investors, put myself out there, I'll give the tax-free growth, and I can control and manage the terms and conditions of everything, especially exit. Because when you look at most businesses that bring in private equity, or they take venture capital, or they do notes, or, round A, round B, round C, really when the time comes, the big exit scenario is trying to go public or selling the company. But a lot of times for a business owner, neither one of those two exit options may be the best at that moment in time. But yet as a business owner, you've got investors that are trying to encourage you because they want to now get out. They've been in it long enough. And this program gives that business owner the ability to dictate and control what an exit would look like. So instead of maybe going public, instead of maybe selling the company, maybe it looks more like an equity buyback agreement that is done, where the business owner is able to buy back the equity. At the end of the day, they got what they needed. They got the growth. The investors are happy, creates a nice, clean exit, and the business owner is happy because they retained all their equity. So, I think it's a heavily underutilized resource that every business owner in America that is looking to expand should absolutely be looking at. From franchising to manufacturing to data processing, data centers to crypto mining, you name it, it can be done with the Opportunity Zone program.
So you bring up a good point, or a good thought experiment here. Obviously, opportunity zones don't exist everywhere, right? There's only certain pockets of America
they exist in all 50 states.
Okay, right.
And there's 8,700 of these designated on a map, just like you're looking at a paper map, just drew a circle, right? Yep. Everything in that circle, that circle represents an opportunity zone. Everything that sits inside that circle may or may not be eligible. Just depends.
Okay.
It's real estate. Right. Almost all of it is.
So real estate, almost all of it is. But where my head goes to is all right, let's say that and this is probably a scenario in which you wouldn't be able to, or wouldn't be eligible for opportunity zone money or investment. Some tech bro finds a pocket that of an opportunity zone pocket. I guess the business has to be located in the opportunity zone. So do they have to rent or do they have to own the building? They could just, sorry?
They can just lease an office location.
Okay. They could lease the office location. What if it's a home office? Could they live there?
Well, no, it needs to be a leased office location.
Okay. Gotcha. Now this is a startup of some sort of tech startup, right? And so everyone's remote. They've got hybrid, everyone's remote. So they've got people all over the United States that are working for him or her, but their leased office is in this opportunity zone. Would that business be eligible?
Very well possibly could. And here's why.
Really?
Because the employee, the way that it's written for businesses is it's either 50% of the hours worked by the employee or 70% of the hours worked by the executive team. So he would be classified as the executive team, and whoever else, I'm sure he'd probably have a couple of local people that were going to be with him.
Yep.
That would be the executive team. They would just work out of that office. Then at that point, everything else could be eligible.
So it's either 50% of the employees or 70% of the executive team. That's it. Those are the rules. Interesting.
No. That's not the only rules. Remember, that's your personnel rules. All right.
Okay.
You have a tangible asset rule. You have an intangible asset rule. If, let's say the company has IP as an example.
Okay.
You've got obviously the location rule. You've got the age of the business rule. There's six rules for a business, but by and large, they are very, very, very easy to massage and mold a business to fit, to be opportunity zone.
This is fascinating. Honestly, I am learning so much right now that my wheels are spinning. Okay, I've got another question. This is a very selfish question, so forgive me back at listeners if you're listening to this right now. might not get any value from this next question. All right, because right now I'm in the process of like starting to raise a fund to buy hotels. Okay. So if we, the executive team, lease an office and work out of an office in an opportunity zone, and we're raising a fund, is all of the money, even if it's not an opportunity zone fund, is all of the investment, is the invested money into the fund then eligible for this program? Like, explain that to me.
What you would do is you may have, if you're doing hotels, you may have like a private equity fund that's going to be focused on investing in hotels, right?
Exactly.
Whether buying, building, or finding and fixing. Okay.
Yep.
You do the exact same scenario. You'd set up an opportunity zone fund. So that way, as an investor, I may not have capital gains. I go into your private equity fund. If I have capital gains, I go into your opportunity zone fund. Your opportunity zone fund is subject to one overarching rule for the whole fund. It's the 90-10 rule. First of all, 10% of the fund can go into anything, anywhere, as long as it's legal. Okay. So you could put 10% into Bitcoin. I could put 10% of the fund into whatever the hotel is the private equity fund is doing. The Opportunity Zone Fund would take the hotel idea and go find hotels in opportunity zones.
Right.
Whether it's building or whether it's buying and fixing. Now, the fund can then raise the money, and then all of that regarding the appreciation, all of it becomes then tax-free to me, the investor.
Okay. Yeah, I understand the concept of raising the Opportunity Zone Fund. The 90-10 rule, that's interesting. But my question is, if the fund's headquarters are in an opportunity zone, is the appreciation that is realized by the fund completely tax-free?
No, because it's not the fund's headquartered in an opportunity zone. It's what the money is going to from the fund being in an opportunity zone. Okay.
Got it. So the fund isn't technically a business. Okay, gotcha. So
the fund is technically a business. It's going to be structured as an LLC. It's a fund because it meets the IRS criteria for this program as being a opportunity zone fund. The fund, when it does its taxes each year, is going to file a 8996 tax form indicating that it's an opportunity zone fund. That's how the IRS knows. Okay. Obviously, if it's a fund and it's raising money, you've got other SEC related standards to be a quote fund, to do it the right way. But assuming all that stuff is good, the fund does not need to be headquartered in an opportunity zone. The fund could be headquartered at your house. Right? It's just what the money goes to has to be an opportunity zone eligible asset, a QOZB.
Yeah, understood. Now, I'm in Silicon Valley. There's a lot of crypto startups. If a crypto bro decides to headquarter in I feel like this could be, I don't know, like if a crypto bro decides to headquarter in an opportunity zone, the exec team literally lives in the office because that's what they do here in Silicon Valley. They eat and sleep in the same place. Yeah. And then people invest in that business. Is that good, or is that possible?
Very well could be.
Really?
Right? Very, very well could be. Huh. And a lot of it's going to have to do with what the crypto bro is doing with the crypto, the business itself, how the crypto supports the business, the revenue model for the business. But, examining it, there's a strong possibility that it could be.
Huh. That is crazy. Oh my gosh. Wow. I'm going to send this episode to some of my friends. Hey, other side team.
Are you familiar with Bit Capital or Redivider out in Miami?
I am not. I am not. Why do you ask?
Both of them were early on crypto in OZ.
Really?
Yeah,
wow.
There's already examples of it.
So people are already doing it, is what you're saying. Oh, wow. Those guys are smart. Oh my goodness. All right. Well, side note for you, or something that popped up into my head earlier and I wrote it down, because we know all funds are syndications, but not all syndications are funds. So does it have to be an opportunity zone fund, or can you syndicate a deal in an opportunity zone and still realize the same benefits?
No. The fund is the reporting vehicle to the IRS. The deal itself that's being syndicated in an opportunity zone doesn't do anything OZ reporting when it does the taxes. So you get no benefit bifurcating the fund. As an investor, I've got to put money into the fund first. The fund is going to recognize when it reports that I'm an investor, and then the fund invests into whatever it's going to be investing into, whether it's real estate or business related.
Now, I'm assuming each fund has its like a varying investment theses, right? Like each fund has their own investment thesis.
Each fund should have the full PPM numbers, literally everything that you would give to an investor. You would do private equity. Because all an opportunity zone fund is a private equity fund. Really look at it in that lens. It's private equity first with tax bolt-ons and all the tax language, tax risk disclosures, program language that explains everything. So it's just a beefed up variant of a private equity fund. So, and then it reports to the IRS utilizing the 8996 form saying that, hey, IRS, recognize us as an opportunity zone fund. So that's how it becomes that.
Got it.
But at its core, it's private equity.
Understood. Okay. And I think that's really important because it makes sense to me why they're doing it that way. Now, can an opportunity zone fund invest both into businesses and real estate in opportunity zones, or do they have to be specific?
No. An opportunity zone fund can be a multi-asset fund. It can have a multi-classification of assets within the fund. It could be designed as a venture capital fund. It could be designed as a portfolio fund. If done enough the right way, it could even meet REIT criteria. So, I've seen them early on. They were mainly single asset focused, meaning, one fund, one asset, raise the money, call the day. But now that we've got guidance, virtually every fund is really doing it, raising in rounds, round A, round B, round C, and, identifying whatever the projects are that round is going to go to.
I see. So you can structure the fund to go after one single asset. You can. Effectively syndicating the deal, right? It's just like an extra step. Yeah. No. Okay. Yeah, that makes sense. Okay. So a lot of them were single asset focused. Now you're seeing more funds pop up that are investing into like a more balanced approach, right? Like they have several assets that they're investing into as opposed to just one. Now, obviously, David, we spent a lot of time talking about opportunity zones, and I think we skipped over and you briefly mentioned, okay, you started working on opportunity zones by coincidence, right? You were kind of thrust into that.
Yeah, I kind of fell into it. Yeah. Literally, it was a hotel deal down in Ybor City in Tampa. And I had no idea. My family comes from a background of taxes. My dad's got a brick and mortar tax agency. He's been almost 30 years in Northern Virginia. My sister's an enrolled agent. So you can imagine family holidays are tax time and tax talk, right? Well, I learned in April of 2018, the IRS did a press release announcement and had the map determined for the opportunity zone. And I had a chance to get the map early on, pop the address in, and lo and behold, that address for the hotel was in an opportunity zone. So early in June, it was like June 18th, I think, is when the guidance came out for the opportunity zone program. I read it once and was like, we need to make a pivot. We were already doing private equity. I went back to my dad and my family and some tax attorneys that I knew and said, how the hell do I update the PPM, right? Give me the kitchen sink for disclosure. And so, we go from an 80-page PPM to like a 300-page PPM on the deal and everything. But when we did the press announcement, we were recognized as being the second opportunity zone fund in the country to go live on the program. And if it would have been 1 week earlier, it would have been the first. And then the Florida Department of Economic Opportunity got connected with them. And then that led to doing a bunch of other funds. And then before I knew it, I got connected in with the mayor of Tampa at the time and the Tampa Bay Devil Race, and working with the city to get that location into an opportunity zone. And then it just led to, looking at businesses. And I ended up working with and doing the first business focused opportunity zone fund in the country. And I built that as a franchise fund. John Hewitt, Jackson Hewitt, H&R Block, loyalty brands, Liberty Tax. Well, it's a widely successful franchise company now. It's one of like the top 100 fastest growing in the country. And I looked at it again, wearing the business hat and coming from tech private equity and venture capital investing. I just was like, this is the way to go for business owners. And I just started promoting and building. And my desire was, I looked at this as I could either have my own fund and be my own tree, or I could take a much, much larger scale approach, stand on the moon, look at the earth and say, okay, here's this forest of opportunity zone that's going to go on. Who's the miracle grow for the soil? And that's so our company set out to, look at this program and figure out, all right, where are all the broken bridges at? What type of resources is the program going to need? I got recognized on the speaking stage very early on. Now I've been recognized as one of the top 10 experts in the country on the program. I got 5 of the founding fathers under Trump's administration that helped craft it as part of my team. So,
oh, wow.
Very, very well, established with the Opportunity Zone program. And I just have a heart for it. I mean, the good that it is doing, you can't even explain. It's one thing to make money and be transactional. It's totally another thing to be transformational. And that's what this is doing for the whole country, And I think that, especially coming off of COVID, we had some of the worst hit areas in the country were hardest hit with COVID. And they're opportunity zones, and this is a way for those areas in our country that we love so much to completely be revitalized, and not using government and everything else to do it in a way where I've got to go apply. I got to do grant money. Maybe I got to be a nonprofit status. I got to do this, that, and just, it's too arduous. Very, very few are actually really, really widely successful. This allows anybody, literally anybody, to just go and do it. I just report to Uncle Sam what I've done. So it opens up a whole different way to give access to more people, create more, I think, tax-free investment opportunity for more people. $9.2 trillion is a lot of money in capital gains. And when the program first started, it was $7.2 trillion. So it's only gone up each year over year, because money's just cyclical. What's not capital gains today ends up being converted into capital gains tomorrow. So that's why that number keeps going up. Just people need to know about it. I just don't know how else to get it out there more.
Yeah, no, it's fascinating, man. I mean, and it's something, you're so right though. There was so much, what's the best word to say? I mean, there was just at the beginning, like in 2018, the amount of excitement around this program was huge.
Yeah.
And then COVID hit, right? So everything that you're saying, it like lines up with my experience, because I really have rarely heard about opportunity zones since COVID hit. And of course, Trump didn't get reelected. And so like that also, I'm sure, like changed things a little bit, even though the program had already been successfully rolled out at that point. It's fascinating. It's fascinating hearing you talk about it. And even myself, I'm thinking like, man, what deals have I looked at recently that are in this type of opportunity zone? Like, there's a lot there. There's a lot there. And the fact that you can rehab, obviously, a lot of existing properties would probably not fall under this even if it's in an opportunity zone, it'd have to be in dire straits, right? Because you have to pour a lot of money.
Because there's a lot of ways to take advantage of the program. So let's talk about a real estate rehab that maybe you don't meet the minimum criteria. Maybe that's not even, the rehab's not even done via a fund situation. You could just simply go find a 4-plex in an opportunity zone, go to FHA and get a $75,000 opportunity zone rehab loan, simply because the property is located in an opportunity zone. And that number was increased from $35,000 to $75,000 like 8 months ago.
Oh, wow. Okay. So you can get a opportunity zone loan too?
From FHA for rehab. Yep.
Oh, interesting. Okay. And are are those loans more favorable? Like, are the terms more, rates better? Like what?
Well, I don't know what the going rate is today because I'm not follow the mortgage industry quite like that the way that I used to. But what I'm getting at is that there's a core way when you have a capital gain to take advantage of the program. That's putting the money into a fund. There's alternative ways when you don't have that as your core. Maybe you don't have a capital gain. Maybe you haven't structured a fund. You don't want to go do and find investors, but you're in the real estate game and you found some property that the address, when you looked on the map, was in an opportunity zone. There's purchase loans, there's refinance loans, there's rehab loans, all through the federal government, just if it's in an opportunity zone. Okay. Maybe I'm a business in an opportunity zone. And again, just like with the real estate, I don't have a fund to support. I don't have capital gains. I haven't set one up. I don't want to go do the investor game. As a business owner, there's SBA programs that are opportunity zone. There's state and local programs that are opportunity zone. So there's ways to take advantage of the opportunity zone depending on where you're at situationally. The biggest way is structuring and setting up an opportunity zone fund, raising money, and just hitting it hard by doing quality investments.
Love it, man. Wow. I feel like there's been so much knowledge dropped in this episode, and like I think that we could probably go for like another like hour or two. Like I'm just like that. My head is spinning. There's so much information that like I'm trying. If you're willing, we can maybe do a follow-up episode. Hopefully after, like once the bill has hopefully, fingers crossed, passed, you can do a follow-up and talk about the new legislation or the updated legislation and kind of forecast what that means for investors, rolling into 20, then 30 or whatever the day is, right? Whatever the year is that they choose. But yeah, man, just a couple of final questions for you here as we wrap up. The first one being, what is it that you're working on now? Obviously, we heard about your journey and everything, but like, what are you doing right now? And how are you applying all of this knowledge?
Wrapping up our development of the Opportunity Zone Exchange. Okay. The idea is just like how Coinbase was for crypto in the very beginning. Big centralized spot, you could go create a wallet, find a coin and invest into. That's the idea with what we're doing with the OZ Exchange. The heartbeat of it is compliance driven. Going back to this being Uncle IRS, the one drawback to the program is, let's say that I did have a capital gain event. I put it into your Opportunity Zone fund. You hit a freaking grand slam. I love you at the end of 10 years. You took my $1 million, converted it to 20 million in profit for me. You and I are best friends. As a result, I go to file my taxes. You think Uncle Sam is just going to roll over when I claim 20 million tax free? Or do you think they're going to send me out a letter saying, hey, we just have a couple quick questions on the 20 million before we accept it, right? So the question then is, if I get a letter like that from Uncle Sam, how do I answer those questions? Because remember, the duration of the period is a 10-year window of time for me. So, Uncle Sam is going to expect me to come back and prove for 10 years everything was good all the way through and through, right? The Opportunity Zone Exchange is the heartbeat of it is designed to be able to do just that by capturing all the transaction information that happens, because everything is done escrow to escrow to escrow. We're able to generate automated compliance reports. So if you ever did get a letter from the IRS about the utilization of the program, the exchange can say, here's exactly how everything is compliant each and every year. Then it serves, the byproduct of it is to serve as a connection point, a spot to where, because right now, with it being I look at this really from a financial market space. When you've had $300 billion flow through it in 6 years, that's no small ecosystem, number one. Number two, when you have a market cap last year of potential eligibility of 9.2 trillion, again, that's no small number. That's a financial ecosystem. It's a financial market space. Unlike stocks, cryptos, bonds, everything else under the sun that's been established for quite some time, what the opportunity zone space has been missing. And a lot of it is because we did lose the rah-rah siskumba. We lost the spotlight on it, which meant we lost the need and the spotlight around proper resources being built to support and sustain healthy growth of the ecosystem. So, for example, if I had capital gains and you have an opportunity zone fund, where do I go to find you? Where do you go to find me? Both of us need each other,
right?
But what's the bridge? Maybe
and
I'm
we're
a business or a real estate development. Again, we have a symbiotic relationship. My fund needs you. You would like to have what my fund has. How do we get connected, right? And so when you start looking at that and you realize there is no connection point, we said we had to do something. So
interesting.
We spent the last several years developing out, taking all the guidance, all the ins and outs, and completely programming an exchange environment to where I could just, as an investor, I could sell Bitcoin. I could go to my CPA. He could just, hey, Dave, sign up for a free account on the exchange, find a fund you like and invest. You'll be good to go. And for funds, it's a lot easier way now to, instead of going out and having to do the road show and dump a ton into marketing and everything. Now it just allows you to go to one spot where your investors are going to go to and for you to be out them to get connected to you. And then everybody gets compliance reports, keeps everybody happy. So that's the big thing.
That's awesome, man. That is so cool. And I was actually I was going to ask you, like, how do people figure, like, how do people find these kinds of opportunities? Because it's like, it feels like you kind of have to know somebody that knows somebody, right? Because you don't really see it, but now you have the Aussie exchange, right? So now you have that.
Yep.
That's awesome. Well, where can listeners find more? First of all, where can they find more about you and then the exchange? Obviously, the links and all that good stuff, we're going to have them in the description and in the show notes. But where can they find more information?
Our website is, well, first of all, I'm going to give a couple different websites. Okay. So the very first one, let's just say program awareness, program education. I want to learn what is the Opportunity Zone program. The best site for that that you can go to, and it's one of our websites, is opportunityzones.org. Very easy to remember. Okay. If you're interested in Opportunity Zone funds, if you're interested in connecting with me, if you'd like to have a one-on-one conversation, my website, our company website is EasyOZ, EAZYOZ.com.
Love it. That's awesome. Well, David, in traditional Gould Mine fashion, I would love for you to leave the audience with one final gold nugget.
Get activated with this Opportunity Zone program. I just educated you. Now the next step is get activated. You can do it. Anybody can.
That's amazing, man. That's amazing. Well, David, you have been a wealth of information. Thank you so much for stopping by, man. And I am positive that this will not be the last time that you are on this show.
One here.
Yeah, man. This is so much fun.